Have a unicorn on set. He's not really a unicorn himself. I mean, he doesn't have a horn or anything. With us right now, TransferWise recently hit a valuation of $3.5 billion. It's a European-based fintech company that is waiting to go public. And joining us right now is Kristo Käärmann. He's the CEO and co-founder of TransferWise. The company ranked number 23 on CNBC's Disruptor 50 list this year. Good morning to you. Thank you for being here. What do you make of this idea of what Leslie's talking about here?
Well, what we just did in TransferWise is we raised a $300 million all-secondary fundraising as a private company. And what we intended with this is to be able to choose when to go public. We don't have anything against public companies, but we're just really in the very beginning of our journey, and we feel the focus is much better in the private market.
That may very well be, but the flip side of this question is, are companies just staying private too long? And ultimately, is the investor base a quasi-public anyway? Meaning, I don't know where you are yet, but at some point, if you want to stay private, you're going to ultimately probably bring in so many of these other funds, whether they're private wealth funds, whether it's the BlackRocks or T. Rowe Prices or the others, so that actually when you go public, there's nobody else, there's no additional market wanting these shares.
I think you're right. There is something happening here where the borders between the private and the public are just blurring a little bit. You're right. When we raised our latest round now, we had companies like BlackRock investing in our round. And it allows us to kind of shift the shareholder base, who started with folks who are investing in seed stage, a couple of people to get the company off. But now, in the later stages, we have effectively public market investors also looking for opportunities in private markets.
So what is that going to do to does that mean that you'll never go public?
Not at all. I think, public is it's a good place to be eventually, but we're just so early, and at the moment, execution speed is what really, really matters.
How much of your delay is because of the cost of compliance and the burden of compliance, particularly in dealing with compliance in the U.S., which is probably the most stringent market there is? Because it seems to me the advantage of being public would be a lower cost of capital for sure. Even this last round you did would have been cheaper in the IPO market, but you elected not to do it. Is there a hidden reason about compliance that's keeping you away?
I don't think it's compliance, actually. I think it is focus. And I don't think that if we believe that there's some distraction in the public markets for founders to pursue their mission with their companies, I don't think it's coming from compliance or just compliance. The interesting nuance here is TransferWise is a profitable company. So we're one of those tech startups that has been already profitable for 2.5 years, which in some ways gives us the kind of opportunity to remain private longer.
But I guess the question that I'd ask is, and you said you didn't want your company to remain private, are you worried about demand on the other end if and when you ever want to be public? Because I'm assuming the BlackRocks of the world eventually do want to have some form of an exit.
Sure. I honestly don't know what the markets are going to look like in a few years down the line, and whether stock markets are going to work exactly as they did today or 5-10 years ago, or some
dual
different.
voting class shares. When you do go public, whenever that is, are you going to have a dual voting class structure?
Oh, this is a great question. I wish I had an answer for this.
Well, let me give you some advice. Don't do it. I will never invest in your company if there's dual class. What am I, a second-class citizen? I shouldn't have a vote to kick you out if you're doing a bad job?
That's your advice. Thank you.
Well, to Andrew's point, too, kind of about the crossover investor dilemma, crossover investors, meaning the BlackRocks of the world who invest both privately and publicly, it used to be that having them in there in kind of later stages would help with valuations, because they could say, I'm a public market investor. Here's what I would be willing to pay in the public market for your stock, but I'm doing it privately, which should create more of a smoother transition into an IPO. Do you still believe that's the case, even though we've seen some pretty high-profile examples recently where crossover investors weren't really kind of in line with what the public markets were willing to pay for the stock?
Valuations are a very, very difficult topic. I wouldn't be able to comment on those, how they differ in private and public. We've seen examples go both ways where companies are overpriced in private or underpriced in private. It's an amazing question, but I don't really have an answer for this. I think the crossover point, that's also blurring now. I don't think we have crossover investors. We just literally have public market investors. starting to look into the private as well.
Before we let you go, what about the opportunity for somebody to buy you and just take you out completely? There are so many different financial transaction companies these days, whether it's PayPal or somebody else. Would you be open to an acquisition?
I mean, we're trying to think everything from our users' perspective. So users, do they care under which brand you operate? Maybe not as much. They just care about the product. But then again, if you think as a founder about an acquisition, what are you getting from it? Like, how does it make it your product?
I don't know. I just
better?
wonder whether a PayPal or an Alipay or someone would give you distribution that you wouldn't otherwise have, and that could actually turbocharge the business.
It's a very good question. We're not particularly.
How did you become profitable when 80% of fintechs never get their customer acquisition cost below lifetime value? How did you do that?
That's a very good question. The thing is, we spend very, very little on advertising. It's mostly word of mouth. And especially in fintech or financial services, I find it's very hard to follow ads. You follow what your friends say. If your friends use your product, your friends use TransferWise, they'll tell you you're a bit nuts if you still go to a bank and do an international wire for $35 and then it's 5% in the exchange rate. You trust your friends.
A profitable fintech that is a unicorn.
Right.
None of these things make money.
Kristo, thank you.